Well, it's officially here. 2022 is right around the corner. As we hopefully enjoy our final week of 2021, here's what I'm asking. Do things get better or worse for consumers and investors? Now, quick survey. How would you rate your 2021? I would say the results are in. The poll shows that 2021 is slightly less sucky than 2020. That's, of course, an official poll that I just made up today. Now, with the inflation sitting around 7%, here's the question we have to ask. Will we see inflation data trickle higher? Will we go into double digits, 10, 11, 12%? Or will tightening monetary policy and steady rate hikes by the Fed and other central banks around the world tame what is causing people to feel that things aren't getting much better? So all that and more on today's Pulver Report. By doing some research and a lot of reading the last couple of weeks, I keep seeing these words pop up. Inflation, reflation, stagnation, stagflation, deflation. All these terms are getting tossed around. So I wanted to quickly define them and talk about where we are and where we are likely headed. So inflation and deflation are opposites, and with extremes, extreme inflation or hyperinflation or extreme deflation, they're both considered bad for the economy. And we also have some fancy hybrid terms. Stagnation is a prolonged period of little or no growth to an economy. Stagflation is when we have slow economic growth and high unemployment, and so you have stagnation with inflation at the same time. Then we have reflation. This is where we have fiscal or monetary policy designed to stimulate spending and curb deflation. And we have been seeing a lot of this since 2007. Now, if you think about where we have been in recent history, this is what a typical business or economic cycle looks like. When the market hits its peak, when the market resists higher prices, a decline often begins. Now, this decline can become a contraction phase, and if it lasts long enough, it can create a recession, just like we had back in 2008 during the financial crisis. It took over 5 years to break into new highs for the S&P 500 and the Dow Jones. Now, interestingly enough, it took only 3 years, to break the highs in the NASDAQ. So it's interesting to note how tech recovered faster. Now, let's fast forward to the COVID crash of 2020. From the February 2020 high, it took just under 6 months for the S&P to regain the highs. It took around 11 months for the Dow Jones to regain its highs. And again, it took only 4 months for the NASDAQ to regain the highs. So tech recovered faster. Now, why am I showing you these charts? Because whether you know it or not, 2008 was the closest thing to financial Armageddon that we have ever had. It was a brush with fate that would have reset the world as we know it, okay? But the Fed essentially became the world's bank and backed the debt and gave lifelines to failing corporate sectors. But guess what? 2008, it actually pales in comparison to what we saw and did all over again in 2020. Now, I'm not saying that all this has to end badly, but I am saying that how can this actually end smoothly? Now, with household wealth at an all-time high, pent-up demand for real estate, houses, furniture, home goods, cars, computers, phones, travel, stuff in general, drove heavy demand that seriously disrupted supply chains and logistics, right? They couldn't be met. So demand is super high, supply is playing catch up, prices increase, and that is our inflation and supply chain situation. So how will inflation be tamed? How can we keep it at 7% or lower instead of trickling up into 10% or higher? Once the general consumer has had his or her fill with goods and services, or they feel like they can no longer afford the said goods and services, demand will decrease, allowing supply to catch up. Now, hopefully, decreasing prices and allowing things to become more available once again will kind of bring things back to normal and find some equilibrium. So in 2022, are we still going to be waiting 3 to 6 months to get a car? How about 3 to 6 months for a new couch? Or good luck finding something like a PlayStation 5. To say that 2021 was a bit of a cluster is pretty accurate. The silver lining is that we didn't actually have the financial markets implode. They didn't contract like we would have expected them to do with a bear market bout from the 2020 COVID crisis. Remember, we saw 20 to 30+% sell-offs in about a month. Here's what's going to make 2022 interesting. With the Fed and other central banks, let's see what tapering and actual raising interest rates does for the economy and the markets. The theory is that we're going to do this to tame inflation, which is around 7%. And again, this is way higher than the typical 2% target that most developed nations are trying to operate with. And if you're using the stock market as a barometer, let's see if the tops form and actually stay in place for more than 20 to 30 days. Because fun fact, since the 2007-2008 financial crisis, we have seen 270 new all-time highs notched in the S&P 500. That's roughly 14% of trading days are trading at new all-time highs. And the 100+ year average is 5%. What does this enforce investors to do? Well, they have been missing out because they're not buying highs, so this is forcing investors to literally buy all-time highs over and over again. We have had a lot of money-flavored rocket sauce that has fueled this rally, and the rocket's only kryptonite is tapering and tightening. So if the Fed truly tightens and removes the ever-accommodative safety net and removes all the language that soothes the market's insecurities, sideways or a correction cycle is appropriate. The US and the world cannot keep kicking the fiscally responsible can down the road.
Sir? Sir, are you listening to me, sir?
But we are doing that right now indefinitely. And the longer and longer this keeps going, the longer this expansion stretches, it's just going to end badly later. Here are my go-tos for the new year. Buckle up for volatility and uncertainty. The markets kind of hate it, but it's likely coming in more ways than one. Next is know how to position your portfolio. Stock investors can really take advantage of options. You can trade covered calls, strangles, credit spreads. These are all great strategies to lower your cost basis and generate income even if the stock price goes slightly down, goes sideways, or goes up. One of my personal favorites as an investor is dollar cost average. If you have stocks you plan to own for the next 1, 3, 5, 10 years, keep adding to them like an investment. If you like cryptos as an all-purpose hedge, an anti-dollar, anti-inflation, and an appreciating asset in a hopefully deflationary future, I like adding to Bitcoin and other major cryptos every month or every quarter, and certainly at the key levels I keep referencing in my live Pulver Report sessions. With the rise of cryptocurrencies, I think we have an amazing opportunity on the horizon that we can get in early, build a formidable position, while mainstream adoption, regulation, and acceptance is still in the very early stages. So cryptos could be a very big part of one's portfolio in the very near future. And my last step for 2022 is don't stress. Life is stressful enough. Don't make investing harder than it has to be. If you're a long-term investor, keep investing. If you're an income generator, be very protective with your risk and protect profits often. This is active management. And if you're just getting started and you want to learn how to trade, look, give me a month of your time. Let me introduce you to Forex, to cryptos, to stocks and options. And if one particular asset class resonates with you or seems like this is what I'd like to trade, then stay engaged and learn more, and I'm going to teach you more. With as profitable and steady, kind of eerily steady as 2021 was, I'm not as optimistic and rosy for 2022, but I'm 100% ready to trade it. I think cautiously bullish will still be my MO. I think it's all about risk management. It's all about accountability. If the market throws us a curveball, let's be prepared for anything. If the market continues to stretch higher, let's enjoy the ride, but know what's likely coming around the corner. If the market tanks and all hell breaks loose, let's be diversified. Let's have a plan B, a plan C, maybe a plan D, so we're not the victim of circumstance. Because what it feels like right now is path of least resistance. It might feel like the market is out of control. Sometimes correlations are broken, but risk management is your best friend. And I think that if we can survive 2000, survive 2008, survive again in 2020, we can survive whatever comes our way. And as the great philosophizer Joe Dirte once said, life's a garden, dig it. So stay healthy, stay happy, stay ready, and I look forward to seeing everyone very soon in 2022. Before you go, please smash that like button for me and like the video and help the channel, support the channel. If you're interested in trading with me in 2022, leave a comment, trade with Chris. I'll reply with a link to my trading rooms. You can also go to my website, pulverreport.com. That is www.pulverreport.com. You can see more information in the trading room section of the website. All right, so I'm officially out of here. I look forward to celebrating the end of 2021. Look forward to making 2022 a great and my best trading year yet. Trade to be profitable, not perfect. Happy trading, lots of profits, and Happy New Year, everybody. Take care, bye.